Welcome back. You're watching Open Exchange, and Ashley Dickinson, head of fixed income trading at Renaissance Capital, joins us live from the trading floor on that end now with our bond report. Thanks so much, Ashley, for joining us this morning. So we've had South African bonds turning firmer yesterday. We had foreigners venturing back into the markets, and that after selling aggressively in the first part of this week. Take us through the kind of activity that we've seen for the past week.
Yes, Alishia, good morning. We've had a volatile period. Obviously, the Eurozone's been central to most of the volatility that we've experienced in this part of the world. As you quite rightly said, late last week and early this week, we had some significant foreign outflows in our bond market. Two reasons behind that. Obviously, speculative positions that were open in South Africa. I think the guys took money off the table late last week and early this week. And then with the uncertainty unfolding over the Eurozone and, definite default almost on the table as far as Greece was concerned, I think it was run for safe haven. That was the sort of element that we saw major impact in our market in any event. And then obviously the liquidity in our market can quite often turn out to be our own worst enemy, in the sense that we're often held as a proxy or a hedge for emerging market exposure simply because of the liquidity, both on the rand and our bonds. So for argument's sake, if you're sitting with the liquid exposure to something like Turkey, for argument's sake, and you can't get out of that, you'll obviously sell your South African or sell a South African exposure. Yeah. Doesn't always work out that way, and quite often you can end up getting into a bit of a strangle as opposed to a hedge. And then we saw the turnaround coming as a direct result of Timothy Geithner's comments. And Timothy Geithner had said earlier in the week, we should have seen the warnings there, had said earlier in the week that under no circumstances should we see another Lehman Brothers debacle, and that the Eurozone was slightly behind the curve. And obviously they needed to put some sort of proposal, some sort of structure in place to ensure that there wasn't a systemic banking risk or a default. Which then turned the whole thing on its head yesterday. As you quite rightly said, the foreigners came back in, covered their shorts, and we saw some decent buying going on as well. But we still are net down for the week in terms of outflows. And, listen, even though the guys have looked at putting this 3-month package together, that doesn't necessarily mean the problem goes away.
Absolutely. So and I guess also, Ashley, sorry to interrupt, but important to reiterate at this point is that flows are very volatile. So we should be careful then to jump to any conclusions on whether or not bond inflows are going to stop or reverse, for that matter, because a lot is dependent on that global economic scenario and the kind of confidence and sentiment levels we see that triggering.
Absolutely. We've seen up until recently the foreign investor very confident and very happy to get involved in particularly our sort of market, not only because of the liquidity, but you've got decent yield differentials. I mean, we saw recently the yield differential between, say, our 10-year bond and the US 10-year bond at 610 basis points, which is pretty wide. Yeah. And, even with the currency risk, the pickup has been good. But, based on that, a lot of the guys have been quite comfortable getting involved in our market, not only on a speculative side, but also your investment funds, looking for a yield enhancer or high yield returns. South African market's been providing that for them. But by the same token, as soon as things start to look a little shaky in the first world, everyone runs for the safe haven of, say, US Treasuries and gold.
Of course, we're looking at, the South African market relative to the developed market like the US, relative to other emerging markets. I mean, what's our performance been like in that instance?
Pretty good, but again, then it's been the weight of funds coming in. You could look at us, say, compared to some of the Latin American countries, and say you could get better yields there. But again, I go back to the point that our liquidity is one of the main attractions for a foreign investor. Yeah. Easy to get into and easy to get out of. Performance-wise, thus, because of the weight of funds coming in, has been pretty good. But by the same token, when the guys turn around and run, the moves are violent. For argument's sake, in the last sort of 10 days, we've seen at least 50 basis point loss on, say, our benchmark bond as foreigners pulled funds out, etc. Yeah. And we've always warned that the exit's going to be a lot narrower than the entrance. When people do need to run, and you're always going to get a far more violent move on the upside. When there is any sense of foreigners selling.
Of course, so when those violent moves come through, we see the kind of impact it has on the currency front. I mean, we've seen the weakness that did come through in the first part of the bond market this week coming through with the softer rand, and that rand has been under considerable pressure over the last the past few days, barring yesterday's movement, and that despite the euro and global equities, stabilizing somewhat. And some had raised a flag that it's marking a change of behavior in the local currency that has proven to be pretty resilient throughout this entire crisis. To what extent is that a worrying factor for you right now?
Very much so. I mean, obviously, your currency, once it gets past a certain threshold, let's face it, that from a National Treasury or central bank perspective, they're not too concerned about a weakening rand as long as it's controlled. When I say controlled, you don't just get this violent collapse in the currency, which is always a risk, in this part of the world. They don't mind the currency going weaker. If we saw it going through 750 towards 8, I don't think that's a problem. If we break past that level and start heading towards, as we saw in the old days, that 10 or worse, then that does become a problem. Then you start getting the impact of inflationary imported inflation, etc. And obviously just concern over the stability of a country and through its currency. But at this stage, I wouldn't say the concerns are too protracted. Maybe the currency was a little too strong, both from a local perspective and from a foreign perspective, below 7. So at current levels, not too much of a worry. The fact that it did lose ground rapidly, I think, was a concern. But, at absolute levels, not really that much of a problem at this point.
Well, Ashley, thanks so much for your insights this morning. Ashley Dickinson is Head of Fixed Income Trading over at Renaissance Capital.